Today we're going to be talking about how you can take advantage of a big swing up or down in the housing market, either as a private individual or as a real estate investor. Coming up next. Hi everybody, my name is Dee Burks and this is Retirement Rescue, where we talk about how to make money, save money, and create a retirement from nothing. Well, one of the ways that you can add to or create a retirement from nothing is to take advantage of the swings in the housing market. Now, for most of us, our house is probably our largest asset for most of our lives. And so making a good investment in that home, knowing when to sell and when to downsize or move to a different area, those are very, very important because they're going to make a big difference in how much money you eventually have and can make. It's also important as an investor. If real estate investing is something you've thought about getting into, maybe buying a little duplex or maybe a little apartment building, this will help you decide when to jump into that market and take advantage of it. Now, the first thing we're going to talk about is selling and buying. Just like any investment, the old Warren Buffett adage is correct. When everyone else is doing one thing, you should be doing the opposite. Right now, the market's still hot. Even though we've gone through a pandemic, the market's still high for real estate. So everybody's buying. What should you be doing? Selling. You should be selling and maximizing the gain on your current real estate. Whether that's be a single family home or maybe you have some real estate investments and you're not sure how rentals are going to go here the next year or two, now's the time to sell. Everyone's buying. A lot of them are buying over market value, over the price that's asked. Now is the time to sell. So then what do? Don't be afraid to sit on the sidelines for a year, 18 months, 2 years, maybe even 36 months. I just saw Kevin Leary on a Graham Stephan video where he was going over all of Graham Stephan's investments. And he said that he personally is cashing out all of his real estate and sitting on that money, and he's planning to stay out of the market for 36 months until the housing prices have settled back out, or at least dropped as much as they're going to drop. He knows there's a drop coming of some kind. We all do. It's everywhere. You can't look at anything on YouTube, on the news, without someone saying there's going to be a housing crisis at some point. We know from the previous recession, housing was a big deal. It did crash. A lot of people went bankrupt. A lot of housing went into foreclosure. A lot of commercial property went into foreclosure. And those people who were sitting on the sidelines with their cash in hand, they got some bargain basement deals. And that can be you if you listen to that old adage and you take advantage. But in order to do that, you need to be willing to sit on the sidelines. That means maybe you rent for a year or two. And I realize the argument is, well, if you sell your house at a big profit, aren't you spending part of that profit? Yes, you are. But if you sell your house at a profit and you stash that cash, the money you spend on that rental is probably still going to be way less than if you had waited and the market dropped and your real estate investment that you had in your home dropped with it. You're probably not going to lose that much money. Let's say you have a $400,000 house and the market's hot right now. So you sell it for $425,000 or even $450,000. But let's say $425,000, a little bit over what it's actually worth because the market's hot. Well, then let's say you spend a comparable amount of money, and for most people, rental rates are 1% of value of the property. So let's say you spend $3,500 a month for a rental. Okay, well that's a lot of money, right? That's a little over $40,000 a year. But if 2 years from now the market drops 30%, That would have been well over $100,000 you would have lost on that house if you could even find a buyer. Because you've got to remember, when housing prices drop, because this happened in the last recession, people can't get credit. A lot of them have really damaged their credit because they've lost their jobs, they've had lapses where they were unemployed, and so their credit reflects that. And it was very hard for people to get credit after that last recession. That's probably going to happen again. So even though you might hang on to your house and not pay rental, you're going to lose the value that you would have gained if you'd sold it when the market was hot. And you may have trouble finding a buyer. It may sit there for months and not be sold. So don't put yourself in that position. Sell it now, sell it high, and then rent for a couple of years. And then when the market drops to the bottom, look to those areas that you want to be in and buy low. Now, one of the risks of doing this, you might think, are, well, interest rates could go up. Oh my gosh, what if that happens? Well, the Fed's already said they're really not going to be changing interest rates for the next year or so. And even if they do after that point, it will probably be a very small amount. The Fed is not going to immediately jack up interest rates right as the country's trying to recover from a recession. They don't do that. They haven't done that historically. They're not going to do it again. So the risk of that is relatively low. Now, one of the advantages of stepping out of the market for a little bit and renting is you can really evaluate where you want to live. And what I usually tell people is look for a mid to upper range area. Maybe an area you wouldn't consider right now because you can't afford it. But think about what that area would be if housing dropped 20 or even 30%. That changes the picture dramatically. Because if you sell your house at the high and that new area drops 20 to 30%, you're going to be able to easily afford that area. Those houses will probably be newer, better maintained, more amenities. Since the house is better quality to begin with, there's probably going to be less maintenance. You're going to have less money out of pocket to put into that house than maybe you do where you live now. And the third one is, you're going to live a great lifestyle while that house is appreciating because you got it for a bargain. And that's a great place to be. In the last recession, the people who waited until about 2012, 2013 to buy, those homes appreciated very quickly. In the last 7 years, they have appreciated dramatically. Go back and look at what homes in your area were selling for in 2012 and 2013 and what those same homes are selling for now. That will give you some idea of how easy it is for you to take advantage of the swing that's coming in the housing market. And now let's talk about investors. One of the things that happened in the last recession, because people will let their investments go before they'll let their personal homes go. So what you'll see is commercial property, duplexes, apartment buildings, that sort of thing. When things start to go bad in the housing area, landlords will tend to let that commercial property go into foreclosure a lot faster than single-family homes. And people actually dump it. They just put it on the market for what it will sell for. You'll see a lot of commercial property that comes on the market as a short sale. Now is the time to be cultivating those relationships with bankers and financiers who can help you when the time comes for you to invest into one of these properties and pick it up cheap. Let them know you're going to be interested. Should some of these properties come up in foreclosure or short sale, let them know. They may call you first. That tended to happen faster in the last recession. Those investors got out of those investments quick. And so that will probably happen again. Now, if you've enjoyed this video, please click subscribe, and I'll see you next time.